Silver has been treated as a secondary market, a sidecar to gold rather than a systemically important asset in its own right, and that assumption has shaped how institutions price risk, allocate capital, and manage exposure. Yet that framework is quietly being tested by a development that doesn't announce itself with headlines or spikes, but instead shows up in the margins where stress usually hides, and the question isn't whether it's real, but how long it can remain ignored. At the institutional level, the most consequential shifts rarely arrive as singular events. They emerge as small operational adjustments that appear rational in isolation, but when viewed together, start to point in an uncomfortable direction, and what's happening around silver right now fits that pattern, because the change isn't about price alone, it's about how participants are behaving when they think no one is watching, which is where the real signal tends to form. Behind closed doors, risk desks don't argue about narratives. They argue about settlement, inventory quality, delivery optionality, and timing mismatches. And recent market behavior implies that at least some of those conversations have shifted tone, not dramatically, not publicly, but enough to suggest that silver is being reassessed less as a passive commodity and more as a potential point of friction. And that reassessment doesn't happen without a reason that hasn't fully surfaced yet. Historically, when a market is functioning smoothly, the plumbing stays boring, spreads remain predictable, and incentives align quietly. But when participants start adjusting terms, altering preferences, or tightening conditions without a corresponding headline, it usually signals an internal recalibration, and silver appears to be exhibiting that kind of subtle strain, the kind that only becomes obvious after it's already progressed further than most expect. Within the broader metals complex, silver occupies an awkward position, simultaneously monetary and industrial, liquid enough to trade but constrained enough to surprise, and that dual role means it often reflects stress earlier than gold, but with less clarity, which is why developments here tend to be dismissed as noise until they're not, and the current signals suggest that what looks incremental may actually be structural. From a market structure perspective, the most revealing information isn't found in forecasts or opinions. It's found in what participants choose to hedge, defer, or quietly avoid. And available data suggests a shift in those choices that doesn't align neatly with the surface narrative, raising the possibility that silver is absorbing pressure being displaced from elsewhere, a pressure that hasn't found its outlet yet. If that interpretation is even partially correct, then the implications extend beyond silver itself, because markets don't isolate stress cleanly. They transfer it, often unevenly, and the development unfolding here may be less about one metal and more about how confidence is being redistributed across the system, which brings us to the part of the story that's hardest to see until it's already in motion. The first thing to understand is that this development didn't begin where most people are looking. It began in how silver is being handled rather than how it's being priced, because pricing can be managed, smoothed, and deferred, but handling exposes constraints that narratives can't easily mask, and recent market behavior implies that those constraints are becoming harder to dismiss. In functioning commodity markets, flexibility is the quiet stabilizer. Participants rely on the assumption that timing differences can be absorbed, substitutions can be made, and obligations can be rolled without friction. Yet reports indicate that in certain silver-related transactions that flexibility is being narrowed, not through overt restrictions, but through subtle preference shifts that change outcomes without changing rules. What makes this more than a routine adjustment is the directionality of those preferences, because they suggest a growing emphasis on certainty over optionality. And markets only make that trade when confidence in the back end starts to erode, even slightly, and silver's role as both a financial instrument and a physical input means that erosion shows up faster here than in assets with cleaner definitions. From the outside, these changes look technical, almost procedural, but inside institutional workflows, they alter risk calculations in ways that compound over time, because once a market starts prioritizing immediacy and specificity, it becomes less tolerant of abstraction. And silver has historically relied on abstraction to bridge the gap between paper exposure and physical reality. The industrial side adds another layer that complicates the picture, because industrial demand doesn't respond to financial incentives the same way speculative demand does. It responds to continuity requirements, and when those buyers adjust sourcing behavior, even marginally, it forces intermediaries to absorb stress they didn't previously carry, shifting where pressure accumulates. This is where the development starts to matter more than it appears, because it isn't about a single transaction or a single participant. It's about how small, rational adjustments interact across a network, and when that network includes both financial and physical actors, the feedback loops become less predictable, not more. What's emerging is a market that's still operating, still liquid, still tradable, but increasingly segmented by trust and tolerance, and segmentation is rarely neutral. It tends to harden quietly until an external catalyst forces it into view, which raises the question of what happens if that catalyst arrives sooner than expected. One reason this has gone largely unnoticed is that silver rarely commands primary attention during periods of broader market focus. It's overshadowed by larger asset classes and louder signals, and that makes it an ideal place for imbalances to develop without immediate scrutiny, especially when those imbalances don't manifest as volatility, but as behavior. Behavioral shifts are harder to quantify, but they're often more revealing than price action, and in this case, market behavior implies a growing divergence between how silver is valued on paper and how it's treated operationally, a divergence that tends to widen quietly until it forces a repricing of assumptions rather than contracts. Within institutional frameworks, assumptions are everything, because models don't fail catastrophically. They fail by accumulating small inaccuracies that eventually overwhelm safeguards, and silver's assumptions have remained largely unchanged for years, even as its role in supply chains and financial structures has evolved in ways that aren't fully reflected in risk models. The issue isn't that silver is scarce in an absolute sense, it's that availability is becoming more conditional, and conditional availability introduces timing risk, which is far more destabilizing than outright shortage, because it undermines the predictability that allows leverage and intermediation to function smoothly. When timing risk increases, participants respond by shortening horizons, tightening terms, and reducing reliance on counterparties they don't fully control. And each of those responses, while rational individually, reduces systemic elasticity, making the market more brittle even as it appears orderly. What makes silver particularly sensitive to this dynamic is its position between markets that operate on very different timelines, financial markets that assume flexibility and industrial systems that require continuity. And when those timelines start to clash, silver becomes the adjustment mechanism by default. That adjustment doesn't announce itself as a crisis. It manifests as a series of micro-decisions that gradually shift where risk resides. And once risk concentrates in places designed for flow rather than storage, the margin for error narrows rapidly, setting the stage for outcomes that look sudden but are anything but. As this dynamic unfolds, the most telling signals aren't found in public disclosures or quarterly commentary. They're embedded in how obligations are structured and how flexibility is priced, and available data suggests that in parts of the silver market, that pricing has begun to reflect a quiet premium on certainty, even when it reduces theoretical efficiency. Certainty carries a cost, and markets don't absorb that cost unless the alternative is perceived as riskier than models imply, which suggests that some participants are questioning whether traditional assumptions about silver's interchangeability still hold under current conditions, a question that rarely gets asked unless prior confidence has been shaken. This is where the development takes on a systemic dimension, because silver's interchangeability has long been a stabilizing assumption for multiple adjacent markets, and when that assumption weakens, even slightly, it forces reevaluation elsewhere, particularly in structures that depend on smooth substitution and deferred settlement. The impact of that reevaluation isn't immediate. It unfolds as a slow repricing of behavior, with each participant adjusting just enough to protect their own exposure, and those adjustments don't cancel out. They stack, gradually reshaping the market's internal geometry in ways that aren't visible from the surface. One consequence of this stacking effect is that stress no longer disperses evenly. It follows the path of least resistance, and in silver's case, that path runs through intermediaries that were never designed to warehouse uncertainty, only to facilitate exchange, which increases the risk that a localized issue becomes disproportionately influential. From a historical perspective, this pattern is familiar, not because it repeats mechanically, but because markets consistently underestimate how quickly conditionality can erode trust. And once trust becomes segmented, liquidity fragments, even if headline volumes remain unchanged. What makes the current situation notable is the absence of an obvious trigger, because fragmentation driven by anticipation rather than reaction tends to produce sharper adjustments when reality finally intrudes. And silver's quiet role in this process makes it easy to miss until the consequences are already propagating outward. Another reason this development matters is that it's unfolding against a backdrop of broader structural shifts that change how stress is absorbed across markets. Because silver doesn't operate in isolation, it sits at the intersection of capital flows, manufacturing priorities, and policy constraints that are all becoming less synchronized. When synchronization weakens, buffers that once absorbed mismatches start to thin, and silver has historically functioned as one of those buffers, flexible enough to bridge gaps between financial expectations and physical requirements, but reports indicate that its ability to play that role is being tested by changes that aren't cyclical but directional. On the capital side, balance sheet sensitivity has increased, not necessarily because of new rules, but because of how existing ones are being enforced and interpreted, and that changes the appetite for exposures that rely on smooth rollover and abstract settlement, categories where silver has traditionally been accommodated rather than scrutinized. At the same time, industrial systems are prioritizing reliability over optimization, a shift that alters demand patterns in subtle ways. Because reliability doesn't chase price, it secures access. And when access becomes a primary objective, it competes directly with financial uses that depend on optionality. These two forces don't collide dramatically, they overlap quietly, and the overlap zone is where silver finds itself increasingly constrained, not by shortage, but by competing definitions of value that can't be reconciled without friction, a friction that accumulates rather than resolves. As that friction builds, it changes incentives for intermediaries who sit between these forces, because they're forced to choose which side to prioritize, and those choices, once made, tend to persist, gradually narrowing the market's ability to adapt without external adjustment. The risk isn't that silver suddenly becomes unavailable. It's that its role becomes more rigid. And rigidity in a market designed around flexibility introduces nonlinear outcomes where small disruptions propagate disproportionately, especially when participants assume conditions are more stable than they actually are. What complicates this further is that silver's signals are easy to misread because they don't conform to the patterns analysts are trained to monitor. There's no clean divergence, no obvious breakdown, just a series of minor inconsistencies that only align when viewed through a structural lens. Those inconsistencies show up in timing, in preferences, and in the growing importance of specific conditions attached to transactions. And while each on its own can be rationalized, together they suggest a market that's becoming more conditional in ways that standard metrics don't capture well. Condition-driven markets behave differently under stress because outcomes depend less on aggregate supply and more on whether precise requirements can be met at precise moments. And silver's increasing exposure to that dynamic means that stress events, when they occur, may express themselves as bottlenecks rather than broad shortages. This matters because bottlenecks don't distribute pain evenly, they concentrate it, and concentrated stress tends to force reactions that ripple outward, especially when the entities affected are central to flow rather than peripheral to it, which raises the stakes even if the absolute scale remains manageable. Another subtle but important factor is the feedback between perception and behavior, because as participants sense rising conditionality, they adjust preemptively, and those adjustments themselves increase conditionality, creating a loop that tightens the market without any single actor intending to do so. Silver's historical resilience has relied on the assumption that such loops would self-correct through arbitrage and substitution, but when conditions become specific enough, those mechanisms lose effectiveness, and the market's ability to smooth itself weakens just as reliance on that smoothing increases. The result is a structure that looks stable under normal conditions, but responds asymmetrically to shocks, absorbing minor ones quietly while amplifying larger ones unpredictably, and that asymmetry is rarely priced in advance, especially in a market that's been treated as structurally benign for so long. By this point, the development is less about silver itself and more about what silver is revealing, because markets often expose their weakest assumptions at the edges rather than the center, and silver sits squarely at that edge, where financial abstraction meets physical constraint. What's being exposed isn't a single flaw, but a layering of dependencies that have quietly grown more fragile over time. As systems optimized for efficiency leaned harder on assumptions that were never stress-tested under today's conditions, and silver's evolving behavior suggests those assumptions are being renegotiated in real time. One of the more concerning implications is how quickly these renegotiations can propagate. Because when a market that's widely used but lightly monitored starts to transmit stress signals, they tend to be discounted until they appear elsewhere, often in less forgiving forms. That delay creates a false sense of stability, encouraging participants to maintain exposure longer than they otherwise would, and when adjustment finally becomes unavoidable, it tends to happen in clusters rather than gradually, not because of panic, but because the underlying constraints were already in place. In this context, silver functions less as a cause and more as a conduit, channeling pressure generated by broader shifts in liquidity, policy interpretation, and industrial prioritization, and conduits don't need to fail to matter. They only need to transmit imbalance from one area to another. The risk, then, is misattribution, treating any eventual disruption as isolated or idiosyncratic, rather than recognizing it as the visible expression of pressures that were building quietly across systems, pressures that silver simply happened to reveal first. As long as those pressures remain unresolved, the market will continue to rely on adaptations that trade flexibility for certainty, and each trade narrows the margin for error, making future adjustments sharper and less forgiving, especially if they're forced rather than chosen. At this stage, the significance of this development lies in timing rather than magnitude, because markets can absorb a great deal of strain if given time to adapt. But silver's recent behavior implies that adaptation is happening unevenly, with some participants moving faster than others. Uneven adaptation creates informational asymmetry, and asymmetry changes outcomes, not because anyone has superior insight, but because actions taken quietly by a few reshape conditions, faced later by many. And silver's position means those reshaped conditions can surface abruptly where expectations lag reality. What's especially notable is how little this requires to matter, because no extreme scenario is necessary for assumptions to break, only a modest misalignment between expectation and delivery, and in a market where conditionality has increased, those misalignments become more consequential than volume-based metrics suggest. As expectations adjust, they don't revert easily, because once participants internalize tighter conditions, they tend to build them into future behavior, effectively locking in a more rigid structure even if the original pressure eases, which means the market doesn't reset to its prior state. This is how structural change often takes hold, not through crisis, but through accumulation, where each small adjustment feels prudent, yet collectively transforms how the market functions, and silver appears to be further along this path than most observers realize. If that's correct, then the question isn't whether this development will resolve cleanly, but where its costs will settle, because markets always allocate costs somewhere, and silver's role as an intermediary asset makes it a natural place for those costs to surface first. What remains uncertain is whether this process stays contained or intersects with a broader catalyst that forces recognition beyond the margins, because when that happens, the adjustment window narrows quickly and outcomes become harder to control. For decades, silver's quiet reliability has been taken for granted, not because it was perfectly understood, but because it rarely challenged the structures built around it, and that complacency is what makes the current moment consequential rather than dramatic. What this development shows is not a market breaking, but a market revealing where its assumptions no longer fit reality. And those revelations tend to matter most when they arrive without spectacle, because they alter behavior before narratives catch up. Silver isn't sending a warning in the traditional sense. It's signaling through constraint, through conditionality, and through the subtle repricing of certainty, and those signals suggest that the system around it is becoming less forgiving of misalignment. If history is any guide, adjustments driven by constraint don't unwind easily. They persist until absorbed elsewhere, and when absorption finally occurs, it often looks sudden to those who weren't watching the margins closely. The real significance, then, isn't whether silver becomes volatile or remains calm. It's whether the assumptions that governed its role continue to hold under changing conditions, because once those assumptions fail, the market doesn't simply revert, it reorganizes. And reorganizations, especially quiet ones, have a way of reshaping outcomes long before they're widely recognized, leaving little time to react once the shift becomes obvious.